On the market, certainly in London, Westminster Bridge, it seems to have slowed down somewhat. I have been promising you a review of some of the concepts that Anthony has been discussing in oil, given the fact we've just had oil data. And I just wanted to follow up on this, given some recent data that we've had regarding the price of oil. What I want to talk to you guys about is futures and something called the calendar spread. I know Ant would have touched on this, but just to make sure everybody's up to speed. In order to understand the calendar spread, so the calendar spread being the difference in futures contracts with different expiration dates. First of all, we have to understand what a futures product is, and I'm sure you're aware, but just to cover. Obviously, we have futures. These are the products that you're trading. These are agreements traded through an exchange for settlement of the physical product at a later date. Whereas when I talk about physical or cash, that's the trade right away. So if I was to do a cash trade with you in the euro versus the pound, I would give you my £10. You'd give me 11 euros, and we've done a cash trade on the spot. And a futures market is an agreement, obviously, for us to exchange that physical in the future rather than now. So hopefully everybody's very clear on that. So when we talk about a calendar spread, can be done in options or futures derivative contracts, where you're taking a simultaneous long or short position, long and short position, entered on the same underlying contract, but with different delivery months. So to put it very simply, it would be as if you're going long, let's say June oil, and short December oil. Okay, so you're buying one and you're selling the other, or you're selling June oil, so you're selling oil for June delivery, and you're buying oil for December delivery. And you can see this and why it would work if, for example, we look at the price of oil in June. If you just type CLEM on your ladder, you can find the price of oil in June. So here we're looking at price of oil in June is $48.39. And if you look at the price of oil for December delivery, the code for that will be CLEZ. And there you can see the price of oil is $49.64. So the price of oil in December, CLEZ, is approximately $1.25 higher than the price of oil in June. Okay, that should make sense. Now, that's important that the price of oil is higher in December than it is in June 2017, as I'll come to when I cover the theory. But by all means, you can try out the different months and see how the prices change over time. So back to the theory. For example, if buying the front month WTI and selling the 6-month WTI, you might want to take advantage in the relationship in prices between those 2 months. If you buy the front month, so if you're buying, in fact, the front month in crude oil now, of course, is May. So if you're buying May and selling a later month, that's a bull spread. And if you're selling the front month and buying the further away month, this is a bear spread. Energy prices are incredibly volatile. Spreads, on the other hand, tend to be less affected by short-term noise and more affected by fundamentals. And in this case, when we talk about calendar spreads, that's fundamentals, supply and demand. So here we go on to supply and demand. Rather than money flow, sentiment, or external economic factors, calendar spreads are generally affected by more clear supply and demand fundamentals. And often deferred contracts will trade well above nearby months due to something called the cost of carry. This is the cost to actually store a commodity over time. That has to be reflected in the price if somebody doesn't want delivery until 6 months' time. I'm going to give some examples of this. Okay, so normally the full cost of carry will be applied to a calendar spread when there's ample near-term supply in that commodity. So by the cost of carry, I mean, let's say if it costs you as a refiner $2 a month to store a barrel of oil and to keep it secure and to keep it, to allocate that to me, then the calendar spread of oil future in 5 months' time should be $10. It should, if the full cost of carry is represented, then oil for delivery in 5 months' time should be 5 times the monthly cost of storing that barrel of oil. However, there'll be a much lower spread, or there's even an inverse spread, if the near-term supply of oil is minimal. If there's a very low availability of supply now in the commodity that I'm looking to trade, then actually it will have what we call an inverse cost of carry, or something called a very high convenience yield. This is where we're going to get onto contango and backwardation. So, one thing to think about are factors affecting supply and demand. Why would June oil move at a different rate to December oil, for example? You can look at things like near-term production levels, production potential, divergence in weather, an unusually cold winter snap, for example, or an unusually warm summer period, and also spread trends. So a commodity that has low supply relative to the past and a wide spread would be a good target for bull spreaders if the spread tends to work seasonally. So for example, if a Gulf Coast hurricane disrupts oil refinery production, obviously near-term contracts will be priced higher than those with further out expectations. So the prices for future deliveries will fall because the supply disruption is expected to end. So in that case, you'd buy the short end, you'd buy the near-term month, and you'd sell the future month. You're trading the relationship between delivery dates. Let's have a look at how this looks on CQG. You guys might want to put the code in. For the calendar spread default, it's CLES6. That's oil going for a season 6, series 6, 6-month spread. And in 2014, what we're doing here is we're saying, give me the price of oil today minus the price of oil tomorrow. Very, very simply. Can you see in 2013 and 2014, the price of oil today was up to $10 higher than oil in 6 months' time. In 2013, if you wanted oil now, you would have to pay $10 premium than to receive oil in 6 months' time, despite the cost of carry. Isn't that interesting? And in 2014, we all know what happened. US shale supply meant that oil became oil supply much more highly available. And in fact, that $10 spread almost completely reversed by the end of 2014. Due to the change in global oil supply, you could actually now pay $10 less if you wanted oil today rather than in 6 months' time. And now, very interestingly, here you can see in 2016, and this is in US oil, by the way. In 2016, we're getting back up towards those zero levels. So this is really a response to those cuts in OPEC. Now, Brent would see something slightly different, by the way. Brent would see something slightly different here. There's an interesting pattern in terms of the duration, the difference in price in oil. So what is contango and backwardation? What am I describing here? Well, contango is, if you like, the normal situation where to receive a commodity in the future, it costs more than taking the commodity today. People are willing to pay more for that commodity delivery at some point in the future and cover the cost of carry. Okay, if full carry holds true, that means the futures price, so the price you're paying to receive oil in 6 months' time, is exactly 6 months the cost of holding oil. You don't need to go into the equation, just so you understand. The opposite happens when there's something called a high convenience yield. If you believe that supply of this product is tight and limited, it might be that you're more willing to pay for the convenience of having that product delivered today. Okay, so you're willing to pay more for that, in this case oil, for the front month rather than for 6 months' time. Let me give you an example. What you have here are two types of curve. One's a normal curve and one's an inverted curve. This normal curve means that price from today, prices are moving higher over time. So You might have December oil contracts trading significantly above now. Okay, the yellow line here is a normal curve, if you like. So the yellow line is a normal curve. The blue line here, this is inverted. This is when there's a very limited supply. This is when market participants are willing to pay more for delivery today than they are in the future. Okay, and the blue line is an inverted curve. And what we're looking at here is a snapshot of how these prices, the price of derivative contracts over time. So Ollie is saying, what happened to this calendar spread around when you're writing about peak oil? Well, I can go to that, I believe. Yeah, so in 2008. Well, it was high, certainly. 2008, it was definitely high. It was around $5 to $7 on the calendar spread. And if I take a transition, let me just... we are on a continuation chart. So here you can see that calendar spread throughout 2007. This was the peak oil argument, wasn't it? Moving up to $7, $8 before then the crash in 2008 and 2009. But anyway, when we talk about contango and backwardation, what I want you guys to think about is if we have a normal curve, so if oil in the future is more expensive than oil today, in what direction is that futures contract going to move towards the current cash price? And what you're going to see is something like this, where a forward or future price in contango moves down towards the expected future spot price. Okay. Now it's interesting to think about refineries, by the way. Do you think a refinery makes more money? Think about a refinery. Do they make more money in a market with contango or backwardation? Well, just so you know, the process of refining can take 1 to 2 months. So imagine if the refinery is buying oil at $30.10. It takes 2 months to process that oil into the refined products, by which time they can sell it in the current market for that higher price. By holding on to it and the process of refining, they're actually, just time itself is adding value to their refinery process. So refineries definitely like it in a normal curve, certainly. And actually, there's something interesting you can think about here in terms of refineries and WTI versus Brent. So just for some extra information, the US market, WTI, is quite different to the Brent market. And by Brent, I mean North Sea oil. And where we've had a situation that it's been illegal for the United States to export their oil output, what you've had here is the refineries making an absolute fortune, because the refineries in the United States have been able to buy US oil at very cheap rates because of the oversupply in local oil. They've then been able to refine that oil and sell the refined products on the international markets and compete with those refineries that are using Brent. And obviously, though, their input costs have been significantly lower. So very interesting on the profitability of US refineries specifically. So in a normal market, that futures contract moves down over time. The price moves down over time to the current cash price. And in inverted market, we have something called backwardation, where the futures price over time moves higher towards the expected future spot price, if that makes sense. So contango, we've got plenty of supply, therefore the price in the future is higher than where it is today, therefore that future price over time will need to move down to the current spot price. Backwardation, there's a very limited supply, therefore a high convenience yield for people to pay more today than tomorrow. So by paying more today, it means that the derivative price in the future is below the current price, and therefore over time you'll have a period of backwardation as that price moves higher to meet the current cash price. Okay, so we're just looking at the cost of different, it's the same product, it's just a different delivery date, and how that cost from the front month changes over time. Front month to 6 month future normally in oil. And this happens, contango or backwardation happens because you have convergence between the futures contract and the spot contract. On the day of delivery, remember, effectively the futures contract is the spot contract. They're the same. On that final day, does that make sense? And if you're buying oil futures products for delivery tomorrow, then as it gets towards the end of today, then actually that's just the cash market. So there will always be convergence between the spot price and the future price. So if the future price is higher than the spot price, remember you've got contango, and if the future price is lower than the current spot price, then that's backwardation, and that future price must move up towards to meet the spot price. Okay? And that happens as well because of arbitrage. Obviously, traders around the world, this is the same product, so by buying the cash and selling the future, if there's a divergence between the two in very limited time, then obviously that's an opportunity to make money buying one and selling the other. So what's happened in oil? The most recent and severe example occurred in the crude market, affected long-only strategies. One of the positives of investing in commodities is that in the normal state of backwardation, if you're in a state of backwardation, long-only investment works out well because that futures price will move higher to meet the spot price. So as you roll from the near month into the further out contract, you can basically profit. This is talking about a case study. However, when a German company called Metallgesellschaft lost billions of dollars by assuming the market was in backwardation, buying the futures contracts, rolling it over each time for a higher price, and actually that market changed into contango. What happened here? This was the biggest oil price spike on the futures market, biggest price spike in history, September 2008. Does anyone know what happened here? 9 o'clock in the evening, and we moved over $30 in 30 minutes. This is hopefully going to help describe to you about the delivery of oil. Well, what happened here, and Ollie, this is interesting in terms of your question in the room. Oil had hit $150 a barrel. Oh, Yankee Steve, hello, do you remember this day? Because it was about, I remember it as well, it was about 9 p.m. London time. So, let me explain the theory here. Steve. So Steve's joined us in New York here. Steve, who was the company on the other side of this trade? Was that ever found out? I know it got investigated by the Commodity Commission, but oil was trading $150 a barrel. It was quite clearly a mispricing of this asset, and we started to move lower. And we started to move lower. This is September now, 2008. We started to move lower along with the financial crisis. And this financial crisis, obviously, you had global equity markets dropping like a stone, so oil moving lower. Now, what happened here was that oil traders around the world are very short futures contracts. And you have basically well over 90% of oil traders, about 98%. We don't want to take delivery of oil. We just want to trade it and get out and speculate on the price difference or hedge for the price difference. So what happened here is traders around the world getting short oil, and then really it was a case of psychology where somebody somewhere realized that actually, hang on a minute, if everybody's getting short here, we know that nobody's going to want to take delivery. So if we start pushing the price higher, it might be the case that all these guys going short are going to have to puke at the same time and get out of their short derivatives trade before that contract expires, and they have to make a delivery. So what happened here is, imagine you're getting heavily short oil, you're $100,000, $200,000 on side, and all of a sudden, out of nowhere comes a day of rally. I'm not really sure where that's come from, so you don't take the trade off. The same the next day and the next day, and now you have a problem. And you have a problem because this last big green candle, this is the last day of delivery. This is the last day of delivery, so you have to get out of this trade. And as everybody gets out of their short trades at the same time, boom, there you have $30 spike. Obviously somebody somewhere on the other side of that trade feeling very clever indeed, but this just shows you the consequence of these oil contracts rolling over. Each has a delivery date. And traders around the world that were short here, this would have been short October futures, having to roll over to November futures, being forced to take a loss. So here in this Bloomberg article saying all price spreads no longer signal the shortage sought by OPEC. So what OPEC wanted to try and do is force a state of backwardation. Can you see? Force a state of backwardation, which means that, you know, there's a reduction of supply, therefore a high convenience yield because people are willing to pay more for oil today than they are tomorrow. And in crude oil here, you saw that this spread between the front month and the far month going down, 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 down. Here, going where you see pink bars, this means that oil tomorrow is cheaper than oil today because of, if you like, an expectation of limited supply. So this is what OPEC wanted, a return to backwardation. But actually, we've moved back into Contango now, where oil in the future is trading of I don't know if this is 6 months, data start January the 18th, or month on month, but anyway, oil future prices higher than oil prices today. It says it here, front month versus 13th month. So the oil price in Brent today versus one 13 months away. So Ollie's saying there's been some talk recently about hedge funds heavily increasing their short positions. What's my take on this, and how would this influence the oil price? They're just selling something yet they do not have, as opposed to investors holding long positions. Well, so you're saying here it might lead to some heavy rallies, but Ollie, it was only 3 weeks ago that we were reading about how all of those hedge funds were heavily positioned long. You know, I think what we can take from this is just how difficult it is for OPEC to manage their production cuts, or in this case, you know, mismanage their production cuts. I've got some slides on that as well. Actually, let me see if I can show you. I just cover some new slides on that about how well OPEC have met their production or not. So this is what's happened in 2016, 2017 so far. We're looking at crude oil after that November the 30th agreement. There's November the 30th to cut production. This is OPEC trying to move the price of oil higher, move the market into backwardation rather than contango. And here in March, this is the realization that that strategy is not quite working. So why is it not quite working? Well, two reasons. Yes, the US supply data we've had out continues to surprise. And historically, OPEC have found it very difficult for production to meet their quota. Here we can see, really, we're only looking at Saudi Arabia and Angola that have actually met their targets. This is looking back to January. The majority of countries not reaching their target. Saudi Arabia and Angola standing out. Certainly that was by 2007. So I think it just shows how hard it is for OPEC to try and control global prices now, especially that you've got the US as a major supplier of oil in the market. And as long as the US is there, we will find it hard and continue to find it hard to move into backwardation. We'll find it hard to move into backwardation because there is no, if you like, feeling of future limited supply. So just to explain again on backwardation and Contango, you can set your trade. Actually, what I've got here, if you want to discuss this further or look at this further, is how you would set up your CQG to look at these concepts. So you'd have CLES, in this case you would have CLES6, and then you have the final month, so that's looking at December to June. Or you'll have CLES6, in this case you might have CLES6 M7 for June versus December. And here I've got it for crude and Brent, for WTI and Brent. It's definitely interesting to see how these prices change over time. If we're looking at it now, so there's a $1.30 difference. Not a huge amount, certainly not a huge amount. That means oil in December is $1.30 more expensive than oil in June. But you can see that almost got back to a period of backwardation back in February in US oil. And now we're back comfortably in Contango. Okay guys, I hope you found that interesting. Thanks very much for taking part. Any questions, please do fire them my way. I'm happy to send the slides to you if you want, just let me know. Thank you.